Darrell. It's not Darnell. I'm sorry. It's Darrell. My apologies. And Darrell says, sorry if I asked this in the past, but I want to create an income portfolio of 10 to 15 stocks, but only acquire them by selling puts to be put to stock. I'm wondering if I should sell ATM or OTM to acquire. Selling it at the money gives a guarantee of a quick put of the stock to me. Maybe not necessarily, but you said, is that right thinking or not? Okay. I don't have a slide here for this, but let's just go to naked puts, and I'll just go to the basic search here. The search is designed to show positions, whether we're looking at what Ernie developed with the monthly picks of the day screen or the weekly picks of the day or the OTM puts. We're still looking at positions that are slightly out of the money with a strong premium to give us, close to that 0.5 or greater % yield for a 15 to 20 day period. Now that doesn't sound like a lot, but the key is we also want the stocks to match our criteria as far as not only just the good return, not only a good probability of expiring worthless in this case, which is different than your approach, Darrell, but also to have the technicals, good uptrend, good management, reflecting of good earnings per share growth, a quality company, maybe even a good market cap, so we're not watching fly-by-night positions. Now, as a general rule in this structure, anytime you're selling premium, we want to take advantage of what's called the at-the-money bell curve, okay? And let me just go here real quick. I apologize. I'm pulling up a webinar that recording that I posted earlier today. Okay, so let me run this real quick and change the screen. There we go. I apologize for that. Okay. So the three core principles we use for any strategy, really, but also this mainly is what we teach with the radioactive trading techniques and why it's so effective. The second one, Darrell, is the at-the-money bell curve. You look at any option chain on any stock for any expiration, the at-the-money option, the one you're referring to, is always going to have the highest time premium. I don't mean the total premium. I mean the extrinsic value, the time value, is always the highest. So what does this basic rule tell us? Of course, it tells us we want to be selling at the money or close to it. When we're buying for protection, for speculation, we want to be buying in the money or out of the money to pay into that lower time premium. Of course, what's great about buying, in the money for insurance is that when a stock moves up in this direction, that extrinsic value actually swells because the option is now at the money from being in the money when it had a lower time value or extrinsic value as well. Okay? So, per your question, is that you want to create an income portfolio. You want to acquire them only by selling puts. You don't want to buy the stock directly and start with an at-the-money covered call and have it called away from you. You want to get the stock by selling the premium. And when just looking at it, what would you think we'd want to do? An income portfolio, you probably want to maximize the return. And if you want to maximize the return, you're looking at it at the money to get the highest time value, knowing that you've got a 50-50 chance of being assigned or put that stock, for lack of a better term. Going back now, why do all of our searches, that search I showed you at the beginning when we went into the naked put screen, why are all of these out of the money? Well, the concept is because we're using a slightly different approach. This is the monthly picks of the day screen. Ernie did extensive back testing, and he found a set of criteria, let me show you down here, and this set of criteria showed him, that with the least amount of effort, meaning no real management, trigger points to potentially close if the stock fell a certain amount, but not planning Darrell on getting assigned the stock and converting it to a continued position as a covered call or other strategy. What he wanted was the maximum expiration to just be in this position for 20 days, have it expire worthless, and then the Monday following standard Friday expiration, see what new top 3 or 4 trades match that criteria, open those, not being married to the stocks. not planning on holding them for longer growth, just looking at that 1.5 to 2, maybe 3% income on the top 4 trades, 3 to 4 trades every cycle. I think in this case it's actually 2 to 3 trades every cycle. Have them expire and then move on. Don't even worry about managing them. Okay? So if your plan is to actually get into these stocks and to not have them expire on a consistent basis, that you have a grouping, 10, 15, even maybe 20 stocks that you would like to own long-term, or you think are bullish long-term and good stocks for your 2020 or 2020 and beyond, then I would recommend looking at the at-the-money option, which offers the highest time premium if your goal is to maximize the time value return. Yes, you may get put stocks more often, but just as a general rule, a caveat of options trading, the at-the-money bell curve shows us the best extrinsic or time value is right at the money. That's the richest time value, extrinsic value premium. Why do I keep focusing on the time value? Well, if we looked at this stock here, Winnebago's, wow, Winnebago's down to 53. I thought that was in the hundreds last year. In any case, I'm thinking of URI. No, I'm sorry, I'm thinking of United Rentals, not Winnebago. In any case, if I was to do a covered call, if I bought the stock today at 53.21, let's just go to the call chain and take a look. And I'm going to use standard January expiration to keep it simple. Okay, let's change it to calls only for a moment. So we had, and I used this screenshot in a webinar, that's why there's little to no data here, but the important thing is right here. The downside protection, if I open this position as a covered call, versus the max return if assigned. I know we're talking about naked puts, Darrell, I just wanted to see this here. If I buy a 53.21, the 55 strike is out of the money, but it's offering a 95-cent premium. The 50 strike has the highest premium at 350, but what do we know about that? 320 of it is intrinsic value from 50 to 53.20. So this is only 50 cents or so of time premium at midpoint. The 55's at $1. The 60 out of the money is only at 15 cents. But if I sold the 60 call deep out of the money for only 15 cents or so of midpoint time premium, I can get a 13% return. Well, that's on the assumption the stock gains 680 is at 60 and I get assigned for the maximum return. That's a significant move, of course. Going in the money, I get the best protection. The stock can fall further before I hit break even and start losing money on the trade, but to make 1.1%. For covered call traders, those that were looking for a specific schedule on a 20 or 30-day right cycle, a position every 20 or 30 days, they're probably looking at a 2, 3, or 4% goal return with still having maybe 2% downside protection. The at-the-money 55, in this case for Winnebago, is the only one that satisfies that. In the money gives you better protection, lower return. Out of the money gives you no protection, but with a higher potential return, it's all based on the gain in the stock. Higher premium does not make higher return. I know you know that, Darrell, but I'm just bringing it up for a point. Because the same thing is true with the puts. Okay? This might not be a stock that you're interested in, but we can see it blatantly. Stock's trading at 53.21. Now I'm probably going to consider the 50 to be at the money because I don't want to sell the 55 and get put right away. Sure, I'd get about $3.10. The naked yield is about 2%. That looks pretty good. But I'd rather give myself a $2 or $3 cushion, generating 1.4% naked yield in this case. Still having a good probability, probably in the 65 to 70% range of expiring worth. I'm 76.3. That's still pretty good. So in this case, I don't have the choice to go right at the money, which would have the best time premium. And maybe the 55 is still offering a slightly higher extrinsic premium than the 50. In fact, it's $1.16 time value at midpoint as opposed to 70 cents for the 50. But I don't know if I want to sell, even with your approach, Darrell, I don't know if I want to sell that 55 put that's already in the money. I don't want to risk getting put right away on the position. I'm probably still going with the 50 because the 52.5 isn't available. If the 52.5 was available with this plan, with your plan, Darrell, and on this stock, I might go with that one. Maximize the extrinsic as well. Okay? All right. Oh, sorry, I'm reading the next question here. I thought it was a continuation. There it is. Okay. Okay. This was the follow-up or another comment from Darrell, I believe. It says, couldn't close a vertical spread recently until I legged out. Sold each leg separately. Short first, of course. Okay. Couldn't close a vertical spread recently until I legged out. Sold each leg separately. Short first, of course. Is there any logical reason? Now, I'm not really sure on that one, Darrell. I haven't had any issues. Well, most of mine have been expiring worth. Most of my bull put credit spreads have been expiring worthless, especially in the last 2.5 months. That's related to Mark's question coming up in a moment. I usually do the same thing to close my spread. If I've decided to close a spread because it's hit a trigger, Darrell, I go in, I enter to close the position, and I set a net debit to close it, which is within my targets of keeping it to only maybe a 30 or 40% loss of the maximum loss I'd expect to take on the position if it went against me. Again, the bull put credit spreads that I've been trading in the last 2.5 months, I don't think I've had to adjust one of them. I think they've all expired worthless. Yeah, they have. I can say that from probably mid-October to this Friday, everything is expired worthless. I didn't have to do any management on any of my bull puts in that last 2.5 months. All of November, December, and last half of October. Even the first half of October, I think I only adjusted one. Okay, but in any case, I didn't have any issues before that. I'm not sure why you came across it. If you went to close it at, let's just pull up a chart, shall we? I'll just go to SPY real quick, just to see what that was in the last, of course, what, 6 months we call it, or whatever, 6 months to a year. I think I want to go to a year, excuse me. Perfect. Okay. Okay, sorry, there you go, folks. So this is the 3-month chart. You can see there, with the exception of that little hiccup at the beginning of October, I didn't have to manage any. Even in the hiccup at the beginning of December, I didn't have to manage any of my bull puts at the time. But that's broad market. It doesn't mean that's every stock. There's our tricky points, right? Let me scroll down just a little bit more. Okay, there we go. All right, so we had that. There's our huge run. Little hiccup, but not anything major at the beginning of March. That's what I was thinking. There's that June. Oh, it was May to June was really the big one. And then the beginning of August, August 5th through the 10th, I believe, or August 1st through the 10th was that decline. Little pullback again at the beginning of October. And then it was, as Mark mentions for his next question, straight up. Okay, fantastic. So why am I bringing this up, Darrell? Because I don't know what stocks you were in, but I just like to use the broad market indicator so we can get an idea. And my feeling is that if you were trying to close positions, when it would be the right time to close, say, a bull put credit spread, or reverse, if you're in bear spreads and the market's doing this, when you're hitting these more volatile points, or up or down, and if I'm in a bear spread here and the market as a whole started to jump up here, bid-ask spreads might start getting wider. It might be harder for me to close both legs or get filled on both legs the midpoint target I want because it's consistently moving with the shake of the market that day. That might be one of the issues you came across, that when, for me, for example, when I'm in my bull puts and one of these triggers hits, drops below the SMA 20, starts riding the lower Bollinger Band, and I go to try to close my bull put in the stock, well, as it's falling, both of my puts are gaining, but the short put's gaining and reacting faster than the long put. I'm trying to get filled at a midpoint debit that matches my risk threshold of, let's say, up towards about 40% of the maximum. But they keep fluxing. I can't get closed on both for the debit unless I adjust the debit slightly because they keep moving in flux of one another. And that's sort of a difficult issue sometimes. So that might have been the trouble that you ran into. I can only say that from experience. I haven't had trouble closing out both legs for debit. I didn't have to, again, for the last 2.5 months. I think, as I mentioned, I closed one at the beginning of October here. Didn't have a problem. Didn't have a problem at the beginning of August. I'm sorry, I wasn't in bull puts here. It was this one. This little drop here at the end of August. I was on vacation on August, so I didn't leave any bull puts open when that first one hit August 2nd or August 5th. And this one here, I can't remember. I don't think I had any issues in May and June, but I do think I had an issue here. I wasn't getting filled where I wanted in here on one position on both cycles. The other two were fine. I didn't have any positions open here, I'm sorry. But I remember having any issues closing at midpoint debit there. So it might be a brokerage question. You might have to ask your broker. But if you're closing it, trying to close them on the day that the market has that flux against your position or against your sentiment, that could cause you some problems of trying to get out of both positions at the same time for the net debit that you want, where you end up having to leg out of the short and then sell to close the long to exit the position with a desired limited risk. But it does depend on the stock. It does depend on the event going on with the stock as well. Okay. Okay, Darrell says, why wouldn't weeklies be more profitable? They might be. I wasn't talking about weeklies, Darrell. I was just finishing up Darrell's here before I get to Mark's question. I wasn't talking about a comparison of weekly versus monthly, okay? For the naked put and for the covered call, depending on what your approach is, we show both weekly picks of the day and monthly picks of the day. What's the advantage of the monthly? I can go further below the stock price, receive the same amount of credit. No, it's a lower annualized return, Darrell. You're absolutely right. But what's the problem? Inherent. Let's just go back to the main search there. I don't even know if these offer weeklies, but let's take a look. So we were looking at Winnebago. Nice, January 17th, 21 days out, standard expiration, 65 cent, 60, 70 cent premium for the standard January expiration. No weeklies. Okay. Let's go back. And I saw one in here, I believe it was CSX. There we go. All right, so let's go to January 17th. And let's say I want a minimum. Let's take a different approach, Darrell. Let's say I'm interested in Winnebago. I want to generate premium, selling naked puts. I want them to typically expire. I want a good probability, but I also want a minimum $1 net premium. This is not normally how I trade, of course, but I get this question all the time. My requirements are I want to be out of the money, want a good probability, I want a minimum $1 net credit. I actually had a customer a few weeks ago ask me, how can we set up positions to find spreads that offer a 50-cent net credit with a good probability 2 standard deviations apart, a 50-cent net credit on a $1 strike difference? You're not going to be 2 standard deviations away and getting 50 cents on a 1-point spread for a credit spread. That's 15 to 20 cents. That's the way the market works. Okay, if they're there, the tool will find them. But in any case, where would I be? And I hate these numbers, Darrell, but we're going to roll with it. On CTSX, I'd be at the 70.5 strike for standard January expiration. 70.5 strike. There's my naked yield. I want 1.5%. Probability is 70.5%. Stock's at 72.85. So I've got about a $2.20 drop to break even, 70% probability, 1.5% naked yield. That's pretty great. Now, naturally not today, but let's go to January 3rd weekly series. I want a $1 net premium. Well, that's not going to work. I'm going to be here at the 73.50 in the money. So scrap that. And I want a good yield with still a 70% probability. Well, I'm only getting 20 cents. So this is 7 days left versus 21. If I get 20 cents, let's call it 24 cents, midpoint. I get 24 cents for that 71.50 strike instead of the 70.50. But I'm 7 days out instead of 21. So I get 24, then 48, then I get 72 cents. In this case, I'm not at the $1 I could get with a 70.50. All right, so I go higher. Now let's say I go to the 72, which is 35. I do that 3 times. I'm going to be equal to the premium that I'd get annualized with the deeper out of the money 70.50 target. But, of course, got to be here. And that's only a 0.5% yield. But yes, if I get it 3 times, I'm at 1.5%, almost equal. This isn't every stock, but this is showing you sort of based on what your expectations are. Now, Darrell, your trading plan is a little bit different. I know in this case you'd be focused just on the 72.50 for what you said you wanted to do was sort of the at-the-money naked put on that position. So you'd probably be right at the 72.50, a 0.7% return. You get that for the 3rd, the 10th, and the 17th. You're at a 2.1% yield. I'm still sitting at a 1.5. But remember, I'm selling out of the money to have a good probability of expiring 21 days out because I also wanted a dollar premium. There is nothing wrong with doing weeklies if you're getting the premium that you want to match the structure of the trade. If my minimum requirement was an 80% probability, I'm looking at the 1 week out 70-50 strike for January 3rd, but that's only 12 cents. That's likely not going to match my return requirement with my probability that I want. I'm either going to have to find a different stock that offers that, or say that maybe I shouldn't be going for an 82% probability with the weekly, or maybe not trading the weekly. That's going to depend on your target goals, risk threshold, and expectation for the strategy you're using in your portfolio and the stocks you're trading for those as well. Okay, so final one here from Darrell. It says, also been assigned 5 to 6 times in the past 6 months, losing on each one. Solution? Readjust your trigger points. Set trigger points for your positions just as you would to open them. I'm not opening a naked put on a stock that's not trading above the 20 or 50-day moving average. That's not currently in an uptrend. I'm not trading a naked put on stock that has earnings coming up between now and expiration. I don't want to cross expiration with a covered call, naked put, or a credit spread, something that can take a very strong loss on the position. So if you're getting assigned more often than you feel, whether on credit spreads or on naked put positions, it's time to readjust your trigger points. Now, if you've been assigned stock with your naked put approach you first discussed, Darrell, and you're currently at a loss right now in those positions, just put in your stock symbol here, CTSX, and click on stock repair, and just put in your cost per share, let's say $76 for 100 shares. I got assigned on a 76 naked put because CTSX fell below my strike. Oh, that's the wrong symbol, isn't it? Sorry. CSX. I was CSX the whole time, not CTSX. CSX. Sorry, folks. Take out the T. Simple enough. All right. So here what this does is it tries to build you a ratio repair where I don't need the stock to get back to $76 to break even. I may only need the stock to get back to $73.98, $74.18, $74.24. And these are not that far out in time, actually. They're still within the next 40 days, 30 days or so for this particular repair. The stock's at $72.85, I get put at 76. If you're not seeing success on bull put credit spreads, you haven't been successful and you've been having to close them earlier being assigned, I'm going to tell you to revisit the weekly bull put default search and just take the top 2 or 3 every Monday. Because that's what I've been doing, and that's, have a 100% expiration success rate in the past 2.5 months. Okay, so if you're not, I teach this all the time. You can see it in those credit spread videos I mentioned, that this is based on my historical testing and actual trading. What Ernie did to develop the weekly picks of the day, monthly and weekly, and for the covered calls as well, that's what I did here with the bull put weekly. Now I'm going out 14 days on this one. Why? Because long term, through actual testing and through historical testing, the 14-day out options going 2 weeks out instead of 7 days out give you what we just saw, a better credit with a better probability going a little further out of the money and outperformed trying to go week by week by week by week with the same structure, looking for the same good probability, 80 to 85%, and a good return of, let's say, 8, 9, or 10% or higher. The 2 week outs consistently through all of 2015, combined 15 and 16, 2015 to 2017, all of 18, and all combined 2015 to 18, and all of 2019 was interesting. The weeklies did actually outperform the 2 week out for the first time through most of 2019, but not all of it. But that's just what I found with testing. Looking for the right stocks that show the best pliable return, the stocks you want to do with this particular strategy, that bull put weekly screen is very effective for the 15% of my portfolio I use it for. It's been extremely successful, and I do have trigger points in place to close the position so they don't get away from me, because I can't afford to take a 60, 70, 80% of the maximum loss. In this case, I have to close them when they get to that sort of 40%. So my advice to you, Darrell, is reevaluate your triggers for closing those positions. Reevaluate your settings for what you're looking for if it's not working out, naked put or credit spread. And you can go into the webinars page here, powerup.com/webinars.asp, and take a look at the webinars that we have on the 8 ways to manage a bull put. Review that and the trigger points that we discuss. And the bull put credit management is a different idea that may or may not work. But yeah, there's ones here for 8 ways to manage a bull put credit spread under the options strategy section of the webinars page. And there's also ones there on naked put positions. It's further down. I think it's back from 2018. See, there's the 8 ways to manage a bull put credit spread. It talks about the trigger points and management ideas to use. How to be successful with spread trades is another one. I'm just scrolling down, I know. Further. I'm trying to find, there it is. Managing your naked put positions. It's from 2015. But I tell you what, it's probably 90% the same exact content I present today, just with different examples. More modern examples. That's the only difference. If I was to present that the beginning of next year, if I was to present that at February 4th, 2020, 5 years later, it'd be 90% the same content, just with different examples and maybe some 5% worth of new ideas or new thoughts on that, whether you're doing monthly, whether you're doing weekly, or beyond. All right. So let me just scroll back through here, make sure where I stand on these.